Win Thin with us from Brown Brothers Harriman. Good morning, Dr. Thin. How are you?
Hi, fine, Tom. Thank you.
What are you focused on right now besides the wedding? When you look at economics, everything that's out there, what are you focused on this Friday afternoon?
Well, look, basically, all the whole market rundown you just gave just pretty much sums it up. The FOMC meeting this week just basically gave the green light for all these sort of commodities, growth currencies, EM, risk assets to run higher. And until we see a hint of inflation or some change in the Fed policy, that trade seems to be in play. You know, you may say this is all overvalued. You try and short gold now, you try and short EM, and you're going to get killed. So you have to really go with the momentum right now, and that's higher, right. Weaker dollar.
So you go weaker dollar, risk trade, and yet meanwhile, back at the peripheral ranch, bring up dreaded first chart, and we are in search of a peripheral haircut. Talk about jargon, there it is, haircut, a restructuring of European debt. Win Thin, are we anywhere close to that supposed haircut?
Well, if having some officials actually begrudgingly talk about it, I guess we're closer, but in terms of physically, they just keep trying to kick the can down the road. By they, meaning the European policymakers. I mean, I think we've been saying for the last 6 to 9 months that some sort of haircut debt restructuring is going to have to be seen for Greece and perhaps even some of the others. They're talking about it. I believe it's behind the scenes. It's really hard to deny. But you know, the talk is that it could be some real balance sheet destruction for the core Eurozone banks. So there's a lot of negative stuff out there still for the euro, but for now, it's still sell the dollar. Okay, distinction here, and this is really, really important, folks. You heard Dr. Thin say the cliche of the moment, kick the can down the road. That's what the institutions, that's what the politicians are doing, and the market's saying something obviously very, very different. Let's look at the litmus paper. Win Thin, at what point of euro dollar does the politics meet the economics and the markets? Is there a point where they all come together? Is it 150? Is it 155 euro? Well, Tom, I mean, that's a good question. It's a moving target, but you're right that at some point, the economic reality is going to bite. And we're talking about a strong euro, we're talking about austerity on the fiscal side, high unemployment, all the stuff. How much will the voters take? How much will the populists take in Ireland, Portugal, Greece? At some point, the political process breaks down, and the politicians say, you know what, this is unsustainable. Austerity cannot be contained, cannot be continued, and it breaks down. And it's the political reality then dictates the economic reality. We see that in Latin America in the 80s and 90s. I think we're seeing that in play now. So we got to keep an eye on it. But we're definitely reaching some stress points in terms of the real economy in a lot of peripheral countries.
This is well said, and this is critical that we're trying to get into May and into June. Bring up this chart. And I mean this very seriously. You've heard me talk about Avinash Dixit's book on the art of strategy, the game theory of a weak dollar. Would you agree with me? It's not just U.S., U.S., U.S. Everyone over the weekend and into May has to react to this persistently weak dollar, don't they?
Yes, and a lot of it has to do with the Asian central banks, trying to run perpetually weak currencies against the dollar. Again, I don't think the U.S. is trying to actively get a weaker dollar, but I don't think they're unhappy with it at this point. As long as stocks and bonds hold up here in the U.S., the weaker dollar at the margin is going to help growth in exports. I don't think they're trying to debase the dollar, but it's a byproduct. You have Fed running zero interest rate policy. That seems to be a natural byproduct.
Win Thin, we got 30 seconds left here. Bring up this strong renminbi. Here is the fixed and managed float of the stronger Chinese yuan. When you wrote in a note of a deployment of $3 trillion by China to purchase assets around the world, when is that going to occur?
Well, we've already been seeing it. I mean, they've put a lot of this money to work already. They've set up one sovereign wealth fund. If you remember, they tried to buy an oil company here in the U.S., but got slapped on the wrist. So it's clear that they have too many reserves. They keep saying they don't want to accumulate more reserves, but as long as they run basically a very dirty float, almost a quasi-peg, they'll continue to accumulate dollars, as will Korea, Taiwan, etc. Again, they're trying to actively run weak currencies. You're going to accumulate dollars, got to go somewhere. I think they'll have to let the currencies appreciate more, but still very, very heavily managed.
We're celebrating the fixed income market and how it links to economics. Michael Cloherty joins us from RBC Capital Markets. We've been talking with Win Thin of Brown Brothers Harriman. Guys, I want to bring up an op-ed right away. Paul Krugman really establishing a conversation this morning, as he so often does, Let's bring it up here, an op-ed. The intimidated Fed, my interpretation as a chairman, is allowing himself to be bullied by the inflationistas, the people who keep seeing runaway inflation around the corner and are undeterred by the fact that they are wrong. Michael Cloherty, are you an inflationista?
Not an inflationista, but that said, I think that, the odds of any additional QE by the Fed is virtually zero. We'd need a much higher threshold to get any additional action by the Fed, in part because if we get get an economic slowdown out of here, it's a sign that QE2 didn't really work. The results weren't long lasting, so why come back with a QE3 at that stage?
Winston, the idea of an inflationista sets up the idea of inflation worries versus Krugman's worries of unemployment. Which matters more to our institutions, inflation or 8.8% unemployment?
Well, here in the U.S., I mean, it's supposed to be a dual mandate, but it does seem to be heavily weighted towards the unemployment side right now. And I think Michael's right. It's going to be hard to justify further QE, at this juncture. Even if unemployment is high, it says, well, what else can we do? Now, in terms of inflation elsewhere, I'm an inflationista in emerging markets. I mean, that's the single biggest theme for emerging markets right now. And to me, it's very interesting to see a very sharp dichotomy in global inflation trajectories. U.S., Japan, no worries. EM, it's the single biggest worry.
Yeah, let's bring up chart 3 right now if we can, folks. This is just an example. You talk about a win-thin chart increase, many standard deviations wide. That yellow line over on the right is real. That is the price of cotton that looks like a medical chart in that it's out 6, 7, 8 standard deviations. Michael Cloherty, in your world of fixed income, Michael Cloherty, how do you justify that price move, and yet we don't see our sovereign 10-year move?
Right. I mean, in general, inflation expectations have remained pretty well contained so far, but there is a growing group that's becoming more concerned. I think people remain focused on core. We have seen some pass through from commodity prices to core prices. Cotton, one of them. We've seen some apparel prices go up. But until we start to see core moving a little bit more, I think rates are going to stay relatively low here.
Winston, can that commodity price inflation from abroad filter over into the United States?
Well, I think that's really the million-dollar question. Right now, we're going on the assumption that pricing power remains low. That is, the importers, the manufacturers will have to take the hit of the higher commodity prices. In the EM world, that is not happening. It's passing quickly into core. Most of these EM guys are at full employment. Output gaps are closed. So that's where the issue is. In the U.S., it's definitely a sort of a to be determined. Can the labor market improve enough where the businesses can pass on the higher input costs? And at this point, I think Michael's right. So we're not seeing that, but we have to keep an eye on it.
Michael, what are you keeping an eye on then? Are you keeping an eye on the 10-year, the 2s, 10s, the debate over inflationistas? What are you watching as you go to Monday?
I think the inflation concern will remain a big one. Again, there's still some overhang of other issues. We see more people worrying about a potential economic slowdown here. I think that risk is a bit overstated. I think people got too excited about growth a couple months ago and are now getting too worried about a slowdown.
Let's do this rewind. This is from Bloomberg Surveillance, Sirius and XM Radio, 113 in a couple of days, combining those radios together. John Riding, what a great help he was this morning. He told me that Oliver Cromwell's head is maybe buried in the garden of Cambridge University. That's what you learn from John Riding. Anyways, I asked him if he considers himself an inflationista.
I wrote the words yesterday. We're proud to be inflationistas. It is remarkable to me that you can look at the inflation data and not see the inflation. And to say that the Fed should be doing something about unemployment when they've taken rates to zero and have created $1.5 trillion of excess reserves, that the Fed haven't gone way further than any central bank.
John Riding, RDQ Economics. Michael Cloherty, so we've set this up. We've shown a picture of cotton. We show the bond market hasn't moved. You've mentioned a focus on core inflation. With all that said, What will it take to bring these two sides together? Does the inflationista idea go away, or do we all at some point convert over to a belief in inflation?
I think that we can have high inflation in the emerging markets without a spillover to the U.S. That condition can persist for a long time. You can have headline remaining well above core for an extended period. That is a bit of a problem for the Fed. The reason the Fed obsess about core is they think that the best predictor of next year's prices is what happened in the core this year, not what happened in the headline this year. They do look for some reversion to the mean of commodity prices. We may be in a period where that's no longer true. If we do get that, I think you'll see more people jumping into the inflationista camp. We do think inflation is going to rise here. Inflation had been abnormally low for a while.
Right.
We need to get, running a touch above the Fed's target period is not a problem for a short while. We think that core is going to creep above 2% before the end of the year, but we don't think the Fed's going to panic in response to that.
I want to bring this into the terminal, folks. This is not the applause meter for Kate at Buckingham Palace. This is gold, and it's back 9 days, and you can see we've just spiked up to 1548.80. Winthin, with all of your experience here in economics, what does gold signal?
To me, it's not signaling anything except a huge speculative flow into commodities. I mean, remember, gold went up.
You're saying this is all speculation.
No, remember, gold went up when it was deflation we were worried about. Now it's going up because it's inflation we're worried about. I do think at the basis of a lot of these commodity prices, just this huge amount of liquidity out there, the signal from the Fed that we're not hiking rates, that liquidity remained plentiful, and all this money is sloshing around and flowing into these commodities. China's buying gold. Again, this is, to me, you may say gold is signaling hyperinflation or something, but I just don't see it. I don't think it's a reliable indicator anymore.
Michael, what does gold say to you?
Yeah, again, I have a fairly similar view. I'm not too concerned about the gold outlook.
Then
I think it's everything.
Why does the media, and why do all of us, me included, why do we have this wrong? We're riveted on gold or cotton, and yet you guys in finance say, yeah, don't worry about it. Why is that, Michael?
Again, I think that it's a worry, but it's not a sell bonds immediately concern. It is something. Again, the inflation concerns is a significant issue out there. But given the recent softness of some of the economic data, if we hadn't had that slowdown, I think we'd have much greater fears of inflation. I think as we see some economic acceleration, fears will come back in. But until we get that, I don't think that's going to be the number one issue for anyone.
Winthin, we're going to give you the last word here. Michael Cloherty, folks, will stay with us. Winthin, what's the calendar now for Europe? With these spreads out to stupid in most of peripheral Europe, what are we looking for as we go into May?
Well, the EFSF was supposed to keep these peripheral guys, sort of solvent until 2013. They tried to kick the can down 2 years. That's not even working right now. We're talking about Greece at 25% yields, Ireland, Portugal also creeping up. To me, the whole timeline has been shortened. I can't say what's going to break the sort of the straw that breaks the camel's back, but Spain is lurking in the background. Italy is sort of lurking back there. Political weakness at a time of great economic stress. There's a real lot of stuff floating around. And as you point out, the euro up at 150, 155 certainly does the Eurozone economies no favors. So it's going to be dicey, but for now, it's still sell the dollar. For now, that's been sort of the prevailing theme, and that's going to continue for now. With
the Royal Bank of Canada is Michael Cloherty. Michael, this is a great chart. Bring it up. This is this idea of the great moderation. We regressed the 10-year yield. Bring it up here. It's a chart 5, Rex, a 10-year yield regression. My mistake. Sorry, there it is. I get emotional. We need a good regression on a day of a wedding. So here's a 10-year yield coming down, and it shows where we are. Michael Cloherty, we're really within trend. What's the panic about the 10-year yield if we're so nicely within a 20, 30-year trend?
Well, again, I think we're seeing a turn in that trend right now. We had the long downtrend that was consistent with the downtrend in inflation. Now the downtrend in inflation is over, and again, the debate is a little bit more: is it going to flatten out, which is what I think will happen, or are we going to see a little kick up in inflation, which would lead us to a higher trend in 10-year yields.
And Bill Gross gets the media on this and the press time, but the fact is very few people are looking for your flat or lower yield. Really, no one's looking for a lower yield, like a 3.2, 3.1. Is there even an idea that we could go back to 3.0?
I think we'd need some sort of shock. I think Europe would need to get significantly worse, something like that, to take us back down there.
Where's the money being made right now?
Again, what we haven't seen is spread product has been performing very, very well here. Corporate bonds very tight, mortgages very, very tight. I think that some of that is likely to continue right here. Banks right now, in the midst of the crisis, people weren't too focused on bank earnings. All people cared about was bank losses. Now the focus is shifting back to how much can banks earn. The Fed has saddled banks up with $1.5 trillion of excess reserves, which are only paying 25 basis points. I think the further we move out of this crisis, there's going to be pressure on banks to be a little more aggressive with that. That means that I think we are actually, you get a partial easing effect from this greater pressure on banks to invest that money.
Wonderful. Michael Cloherty, we're going to have to leave it there, unfortunately. We'll have you back soon. Michael Cloherty, RBC Capital Markets.